Okay, so we covered really basic accounts. Um, the next kind of grouping of accounts would be kind of a next tier up, I guess, for investment planning would be CDs. That's a certificate of deposit. I mentioned that. Most of you probably heard of a CD. It's kind of a savings type account. It pays a fixed interest rate on money. CDs can range in time, and that's really usually what determines how much their interest pays. If it's a shorter time, it's a smaller amount. If it's a longer time, it's a bigger amount. Remember when we discussed how banks make loans, this is kind of a big part of that, right? So it's more fixed, so they know how long they have to be able to use the money, and they can make those loans based on these type of things. It usually pays a higher interest rate than a CD than a savings account, and currently CDs are in that 5% range for 6 months to a year, in that range. You and I were talking about one here a while back, Brother Reddick. How much was that one? Was it 5% for 6 months or ever? I think.
Yeah, it was 40 up for 5 or 6 months.
Yeah. So
The same bank had a short one recently for 5% for 2 months. It was really big.
really, that's incredible.
The longer one was.
That's unusual for something that high, that short. Yeah. So top national available CD rates are generally 3 to 4 times higher than the national average rate. So you do want to shop around because CD rates aren't static. Like, it's not like every bank offers the same thing. You want to look and see who offers what. Then you'd have what's called a money market, and there's two different types of money markets. There's a money market fund, and then there's a money market account, and those are a little different. And they're an interest-bearing account at a bank or a credit union. They generally are funded, instead of like for bond type stuff, it's more along the lines of a they typically would use like bond. They would invest in bond stuff, and they would pay based on the bond type investments. But remember this about bonds. Bonds do go up and down, so that can impact the value. Remember when I talked about Silicon Valley Bank and how the bond value dropped? That can affect a money market fund more than a money market account. Okay, so they're definitely a little bit different in this, but it can affect that. The money markets, though, are typically pretty good investments for short-term planning. A lot of banks offer a high yield or high interest money market, but there sometimes can be kind of comparable to a high yield savings account. So if it's no different, it might be better to stay with a high yield savings or high yield checking as opposed to the money market, so you kind of avoid a little bit of risk. There's generally speaking, the higher the interest you're going to receive, the more risk associated with the investment. Okay, that doesn't mean you shouldn't invest in things that have a higher risk, because high risk, high reward, right? That's kind of the idea: low risk, low reward. There's reasons to invest in sometimes things that have a higher risk, but you kind of want to just pay attention to that. The next one that would be kind of in the same category, I guess, would be a savings bond. Now, bonds have there's different styles of bonds. Savings bond would typically be what we would call a U.S. savings bond. Would be a bond issued by the government. It's the government debt. That's what it is. So you can invest in a savings bond, you hold them till they mature, and then you trade them in for a return. And so basically, whatever their interest rate is, if it's $100 savings bond with a 5% interest, when it matures, you turn it in, you get $105. That's your your investment. Now, a Series EE saving bond, though, is sold at 50% of their face value, and they fully mature after 20 years. So essentially, it's 100% return, but you have to wait 20 years for a 100% return. Okay, so they pay obviously a higher return rate, but the length of time is quite long. Typically, your market, in a general speaking, in the market, you want to watch the 2-year and the 10-year bond market. Okay, and the reason is that the 2-year bond is obviously going to have a lower, generally lower interest rate than the 10-year bond, right? However, recently this happened last year. The 10-year bond dropped in. They flipped, okay, and they say when they flip, 18 months to a economic recession, and so this is now happening. Guess how often? Yeah, it's kind of in that whole vein of things, right? So they watch the 2-year and the 10-year, and they don't talk about it properly, though. They talk about, it flipped, and sometimes it can cause a recession. It can very often cause a recession. Well, that was true up till 2008, and now it's like it should, but they spend out of it, and so that's where we're at in the cycle, right? Last year this happened, and they know they've got to spend out of it. They can't let it happen, and so the savings bond are a good indicator of where the economy is. Savings bonds are typically where people put money. Most very wealthy people park money in the bond market when it would be called a risk off market. Okay, risk off means that we want to reduce our risk. Okay, and so it looks like the economy's getting too hot. We're getting to this point, where we may have a drop, and what they call smart money starts moving their assets from risk on to risk off. A risk on asset would be one that could be high volatility. A risk off asset would be one that has very low volatility. So bonds, while they do fluctuate in value, are considered a risk off asset. So you're going to have money during high risk times. The bond market is considered to be a safe place to put your money. Now, volatility is something that you need to understand. We're going to cover this and explain this a couple different ways because it really matters in understanding a few other concepts as we go along. Volatility is measured in the stock market in a thing called the VIX, Volatility Index. Okay, and the VIX, if you watch the VIX, if it's 20 or below, it's considered a low volatility market, and above 20 is considered a higher volatility market. When volatility really goes up, when the market crashes. Okay, so if you start seeing the VIX run up, it's generally an indication that the market itself is going down. It kind of runs in the alternate of the market. As the stock prices go up, the VIX here would go down, and then alternate, that way. Okay, so it's like an inverse view of the market, and so there are people that will follow the VIX and they think they can predict the market. Let me tell you my opinion on what's called TA, technical analysis. It has a lot of value in macroeconomics, but it's very deceptive, and it's very difficult to use for micro decisions. Does that make sense? In other words, if you're watching the broader picture, you can see roughly when we're in an accumulation and a distribution. But if you're watching the VIX or any TA, technical analysis, to try and time when to get in and out of an investment exactly, that is very difficult, because technical analysis tells you what has happened, not what will happen. And you need to know that. So if you're watching on a big picture and you can start to see the pattern, you go, oh, okay, I see this pattern has formed and this fits an accumulation or a distribution, then now I can make a decision on a big picture thing. But day traders run on a 1 minute chart. And on a 1 minute chart, you're making, I think it's going this way based on what it has done. And that's like you can predict the future, and that's a problem. Okay, so you're never going to get in and out probably at the bottom and the peak unless it's an accident. It's not because you're so smart. So running that type of thing. But when the volatility is up, that would be when you would be in a risk off environment, because volatility, you want to take risk off the table. In a high volatility market, you want to put risk on the table in a lower volatility market. So that would be back into the more risk on investments. Risk on investments would be stocks, crypto, things such as that. Risk off investments would be money markets, CDs, bonds, these type of things that we've been discussing. Yes.
High volatility is at risk off or on?
High volatility. So volatility, if you think about it at 20, okay, VIX.
Yeah.
At 20. All right. Below is on and above is off. In other words, if it's high volatility, you want to take, if the volatility is high, you want your money safer.
Okay.
Because high volatility is likely that the market's dropping. So you want your money to be safe if the market's dropping. This is where options actually come in to play. Okay, and we'll get to options eventually here before we end the class, and I'll explain options, because options and volatility are really connected, and it's one of the main factors in options. Volatility is one of the main factors for options, and so understanding volatility is key to understanding options. And if you understand volatility and options, it gives you a method of protecting your investments during high volatility, as opposed to taking them all out and putting them in risk off. So there's kind of two methods to protecting. You can go to a risk off, or you can use options as protection. Options used properly are a really good thing. Options most often are not used properly though. So options can make you more risky, and they shouldn't. Okay. So that explain that?
Mm-hmm.
All right. I got some more water for my tea, but whoever got that coffee, Ben, now my tea tastes like coffee. I don't know. Well, it's what's there, So, all right. So savings bonds. Now there's different kinds of bonds too, right? There's the U.S. savings bond, but there are corporate bonds. And corporate bonds are a little bit more difficult to invest in for the average person. There are some ETFs that are bond ETFs that you can buy over the counter. When we say over the counter, we would mean like I could invest in them in my TD Ameritrade account. Well, it's not TD Ameritrade now, it's a Charles Schwab account now, because Schwab bought out TD Ameritrade. But I could buy an ETF. I'll explain what ETFs are later, but it's basically a fund that holds a lot of a certain type of thing. Okay, and there are ETFs that hold bonds, and I could buy those bond ETFs and hold those during that time. Those would primarily would not be U.S. savings bonds. They would be corporate bonds, and there's different levels of corporate bonds. There's AA corporate bonds that are really, really secure. This would be like, let's say, a company that has a really solid track record, let's say Coca-Cola decides to issue a bond to raise funds. And so I could buy Coca-Cola's bond and I'm going to get the interest. It works the same, but maybe I buy corporate bonds instead of the U.S. savings bond. Then those bonds go all the way down to what's called a junk bond. This is a company that has a very poor track record. Maybe they don't have good financials, and it's more risky. Okay, and so those pay higher interest rates than the really secure ones, obviously, because why? They're more risky. They could default, and I could lose my money in those bonds, and whatnot. So but those are all. That's the bond market, and I will tell you this: I know less about the bond market than almost any of these things because it is harder to invest in. It's something that I have not really figured out. I understand principally what it does. It's like, that bond it's a guaranteed interest rate over at a certain length of time. But a lot of times it's difficult. Bonds have different coding. You have to go through a broker a lot of times to buy and sell bonds. And so I just never have at this point gotten into bonds and don't anticipate planning to, because there's other ways to be risk off without bonds. Okay, so now that may be something you want to explore. There are many good books on it, and I would encourage you, if you're interested, to do some exploration. I think it's worthwhile, but it's not something I have done. All right, then there's an annuity. Now, annuities fall in the category of insurance. An annuity is actually an insurance product, and so we're going to talk about a couple insurance products here really quickly that are investments, kind of, okay? And some would say that these are less investments and more assets, okay? And I understand why. So hopefully I can explain this properly. But an annuity is an insurance contract that you essentially purchase, and you can either make monthly premium payments for a period of time and then receive, or you can make a lump sum payment. Like you could either say, if you came into an inheritance, let's say Philip's mom leaves him $200,000, and he's like, what am I going to do with this $200,000? I don't know what to do with it. Well, you could get an annuity. You could take that $200,000 and purchase an annuity. And then what that annuity will do is it will guarantee you income when you reach a certain age. Okay. So let's say you take that $200,000 and you put it into an annuity, and at 62 it starts paying you, and it pays you, $1,500 a month. I'm making numbers up here, okay? But it's going to pay you $1,500 a month until you're 100 years old. So it's like it's a guaranteed income for retirement type planning, okay? It is an investment in that sense that you're earning interest and you're going to get it, but it also could be considered an asset because it pays you to own it, but you're not, at that point, you're not putting more money into it, but it's kind of building, that reserve. Now, another thing that works like this is called an indexed universal life. And there's a lot of argument about indexed universal life. And I'll kind of tell you why, and then I'll give you my personal thought on it, which is just my thought and not a recommendation. An indexed universal life basically works similar to an annuity in that it is you have a life insurance policy. Let's say that it represents a $250,000 life insurance policy. You pay into it. If you die before it matures, then you get that $250,000. If you live to its time of maturity, then you start receiving a monthly payment, just like an annuity would give you. And then it'll pay you whatever that amount is until you're 100 years old. And at 100 years old, you still have, that's an example here, okay? But at 100, or whenever you die, you still get 100,000 of that 250,000 as a death benefit, okay? And so it's like a dual thing. It's like the annuity in that, it makes a monthly payment to you, okay? But an annuity, when you die, basically it just pays off whatever was left, okay? Versus the indexed universal life, where there's a life insurance payment at the end, kind of in that vein. And the amount of that life insurance payment is going to depend on how long you've collected. That's true, but it essentially would never go below a certain point. Okay. Wealthy people, very wealthy people, use these to pass on inheritance. They use indexed universal life to give their children a guaranteed income when they die, and it's all tax-free. Does that make sense? So essentially, they do what they call paid-up additions. They basically buy the policy up front, and if they wanted to leave their kids $1 million, instead of having a term life insurance policy that would expire at a certain age, they just pay up front into an indexed universal life. Indexed means it's tied to the growth of the stock market. It goes up, but it actually never goes down. It has a guaranteed amount that it goes up regardless, but if the market goes up more than that, you get that much instead of the guaranteed amount, okay? And so it's a pretty good deal in that sense, right? It's always guaranteed to go up. An annuity is similar to that. But the thing is that if I was very wealthy and I said, man, I'd like to leave each of my kids $500,000. Okay, I could put $500,000 in my will and say each of them get $500,000. Problem, they pay an inheritance tax. Or I could take whatever money it would be and I could buy that $500,000 indexed universal life. And then when I die, my kids get the life insurance payout, and that's tax-free. So my kids wouldn't pay tax. You don't pay tax on life insurance payouts. And so my kids would get that and not pay taxes on it. So that's why wealthy people tend to use those, because you get a tax-free inheritance as opposed to a taxable inheritance. And remember this, they can raise taxes as much as they want, but politicians are in office because of wealthy donors. They will always put loopholes in there for their wealthy donors, the rich people. Remember the debate when Donald Trump debated Hillary Clinton? She said, he doesn't pay taxes. And they said, do you pay taxes? He said, of course I don't. Neither do any of her other donors, right? Because I'm smart and I use the tax system that she wrote. And I'd be dumb to pay taxes when they put those loopholes in there, right? Well, those are there, and this is one of those things. I mean, this is one of those loops that they use. So you and I might think, well, I've got $100,000 in the bank for my kids to inherit. Well, they're going to pay taxes on that. Okay, so a wealthy person buys this, index universal life, and the kids inherit that, and they get it tax free. And so in that vein, it's a pretty decent thing. The other thing about an indexed universal life is that it provides for what they call bank on yourself. Have you heard that term, bank on yourself? There's a lot out there on this, and this is where a lot of the controversy about these come from. Okay, so principally, you get this indexed universal life. It builds equity over time. Okay, you after so many years, it's worth X amount of dollars because you're putting it in there, and it's like an investment account, and you can borrow against it. And you borrow against it, and you don't pay taxes on that. And so you don't pay taxes on money you borrow. This is a Robert Kiyosaki philosophy. buy, borrow, die. Okay, you buy an asset, you borrow against it, you live on that, you die, it goes up, and the value of it goes up. Your kids inherit it, and they borrow against it, and they live on it, and whatnot. That's his philosophy. I'm not saying that's a good philosophy, but that's his philosophy. Well, an indexed universal life is one of those things that you can use like that, where you can borrow against it as an asset. And so, let's say you have this indexed universal life, and you wanted to buy a car, and you don't want to pay interest out there. You just go and you can literally borrow from that, buy the car, and you just pay it back. And it's like, if you don't pay it back, it just reduces your asset by that value. Okay. So it's kind of a usable in that fashion. And the idea of the bank on yourself crowd is that you put this money into these things, and then you become your own bank, and you borrow from yourself, and you pay back yourself, and you never pay anyone else interest. You're paying yourself interest. Okay, so that's controversial. All right, and part of the reason it's controversial is because you have to put a lot of money into it to get to that point. And so a lot of people say it doesn't make any, it's not a good financial use of money in that sense of, it's kind of there and you're not earning as much as you could earn, and this and this and this. I mean, there's a lot of just debate. There's a lot of debate. My opinion, if you had money to pass on an inheritance, it's probably a really good idea. Okay. I have an indexed universal life, and here's why. I don't have Social Security. So I got an indexed universal life several years ago. It cost me a fair amount of money a month. Okay. As a matter of fact, it cost me, I'm just being transparent here. Okay. It cost me like $800 a month for this indexed universal life. But when I die, or not when I die, when I turn 62, it will pay me $1,600 a month. Remember, I told you I opted out of Social Security. I don't have Social Security, so I don't have any pension type environment or money coming in. So I decided to use this as a guaranteed income for Angela and I when we get to retirement age. Okay. Now, I don't. $1,600 a month isn't going to be enough to retire on. Okay. However, it might buy rice and beans. And so, that's kind of my thought about it. It's something. It's not nothing. Okay. And I quit paying on it when I'm 62. All right. And theoretically, I can start pulling out, or I can leave it in there longer and let it build up to a higher amount over time and start pulling it out later. I mean, it's whatever. And it guarantees that I will always have life insurance. So no matter when I die, and this is the problem with term insurance. Term insurance is great when you have kids at home. Okay. Term insurance, though, is not an investment. It is a protection. And term insurance is based on the length of time, right? How long? Is it a 10-year, 20-year, 30-year term? And it's based on your health when you get it, based on how much, it costs to buy it and such. When I was in my 20s and I had 4 kids, term insurance was the right thing for me to have, because I needed a higher amount. Whole life or indexed universal life would have cost a lot more to own, even though it would have been an asset in that sense. Okay, it would have cost a lot more to own, and I would have had a lower death benefit. So when I was in my 20s and I had 4 small children, if I died, my wife is going to need money to raise those kids. And so I could get a $500,000 policy in my 20s as a skinny guy with no health issues. I could get a $500,000 policy for like $28 a month, guaranteed for 20 years. And so I did that. And guess what? My kids are all out of the house now. I don't need a term policy. My kids are grown. We've got investments and so forth now that we've built up. And my wife doesn't need that. And besides that, at this point, it might just give her incentive to knock me off, you know, if I had too much insurance. And so you gotta think those that way. You gotta lower that number down when she doesn't have I don't need him, the kids are gone, you know, and so you gotta get that number down where it's not worth her time, you know, to try and knock you off.
Will you get penalized if, for instance, you did the index, universal life, if you said, I'm gonna pay for it and then I'll stop after a certain age?
Yeah, well, yes,
You have to continue, or that's what,
it reduces your benefit if you quit paying.
okay.
Until, because it starts reducing your benefit until it goes to nothing. So you need to pay it until it's done. At 62, mine is fully mature, and it will never go down from there.
Do they decide
Yeah,
on what the
when-
age is, or you can say, hey, I
When
want
you
a certain
when you
age?
set it up, but it generally would be in around 60 to 62 would be typical. Okay. Another type of life insurance is universal life, whole life. And that's basically doesn't have that indexed function, so it doesn't do a payment to you. It just is when you die, your family gets this amount. Okay. Yep.
Do you pay that, so you said 800, you pay that every month
Every month.
until you're 62?
Yes.
Okay.
Every month till I'm 62.
Yeah.
But here's what my thought is at the time, and I took that out. I don't know, 5 years ago, 4 years ago, something like that. I'll be 50 this year. 12 years left. Okay, I'm paying $800 a month, but at 62, I start receiving double what I've paid in through that period of time. And like I said, I don't have any Social Security to receive, so it's kind of a a guarantee. If worse comes to worse, at least we have some income. Okay. I'm not saying everyone should do that. Now, I know someone that's quite a bit younger than me. Okay, that did this about the same time, and they're not quite 10 years younger than me. Theirs for the same amount, but they have to pay till they're 62. But their payment is like $300 instead of $800. Okay, so the younger you do this, the lower your payment, obviously, because you have more years to pay. Okay, anyway, I'm not saying it should be done. Okay, I'm telling you what I did and why I did it. But that doesn't mean anyone else should, right? It's just an option that's out there, right?
So if you do die before you get to 62,
$250.
okay, so you just get a set price.
You get the whole the insured amount. Yeah.
Okay.
Yep. The face value of the insurance.
Okay.
Yep. Understand?
Or your wife does.
Your wife does. Yeah.
Put it in.
Yeah, I asked her to write a check and put it in the casket with me. Yeah. All right.
Is that something you would want to do if you're like when you're older? You know what I mean?
I would,
Because if you're younger, it would. You know what I mean?
I would say if you still have children at home, term is the better option for you. I'm not even saying that this is a good option, generally speaking, for most people. I don't think it probably is. I don't care for the bank on yourself stuff. I don't think it's a great option. Okay. I think that this is my opinion. Someone might differ, and that's fine. This is my opinion. Okay. The only reason that I felt it was good for me was because I don't have any guaranteed income when I turned 62.
Yeah.
And so this was a different thing. Otherwise, I probably wouldn't have done it.
Yeah. Because I feel it's like it was depending on the circumstance.
Yes, it's very, very much that way. Now, universal life is generally what you would get for like a death, a burial type benefit. Okay, universal life, whole life. Universal life would be something that you would get like a $10,000 policy or something like that for, and most of the time, insurance companies that deal with like senior Medicare issues would sell these type of policies as a burial policy, so that when you die, you don't have to do anything. You have this certificate. You take it in to the funeral home, give them the certificate, they file it, and it pays for your funeral. Okay, and that would be universal life. I'm sorry, whole life. policy. Now, you remember the Gerber insurance type thing? Like you can buy this for your kid for 62 cents a month or something like that. And, you know, for 62 cents a month, your kids will have $20,000 whole life insurance. All right. Well, you have to pay for that their whole life. Okay. But 62 cents a month for a burial policy when you're 80, but you paid for it since you were, you know, born. Well, that's, you know, it is what it is. But nonetheless, that's whole life. Okay. You understand the difference there? So an annuity, you put in you either pay in monthly or you put a lump sum in, and you're going to get a monthly guaranteed income. And then when you die, you know, the beneficiary gets whatever's left. An indexed universal life, you have a guaranteed death benefit if you die before you start receiving it, and then a guaranteed income after a certain age, and then you still have a death benefit at the end. And a whole life is basically just a death benefit, you know, a smaller amount death benefit. Okay. So there's more to insurance, but those are 4 asset type things that insurance provides that can be used as investment. I wouldn't say they're great investments, okay, but they are security investments in the sense of they can secure so that it doesn't hurt your family down the road in those events that you're gonna die. So I mean, you know, there is that, and you don't want your wife to be trying to figure out, you know, do I bury him in a coffee can in the backyard or something, you know? So because it's expensive, it's more and more expensive it's too expensive to die, so you got to keep living. All right. Hopefully that explains that swath of area. You have another question?
You kind of, so that one, are you gonna go to cash value? Is that what that would be considered like a cash value?
Cash value would be on indexed, universal, and then whole life.
Okay.
Cash value would be what it's worth, and that's why I said that bank on yourself type idea.
Okay. I just-
All right. Next, let's talk about commodities. Now, commodities are interesting because there is a commodity market, and there's ways that you can invest kind of more directly in commodities, but then there are stocks that represent commodities, and they are in the stock market also. So you could buy them, what we call over the counter, in a trading fund, and we'll talk about different types of funds here before we're done, probably Saturday. But commodities would be things like oil, okay, gold, silver, copper, lithium, platinum. You understand what I'm saying? Like there's agricultural commodities, there's energy commodities, there's animal product commodities, pork bellies, beef, feeder cattle and these type of things. There's agriculture would be like wheat, corn, maize, all that type, orange juice, sugar, those type of things. Then you got metals, copper and lead and aluminum and such, precious metals, gold, silver, platinum, that type of stuff, and natural gas and that. So, I mean, you got lots of different things, okay? I'm not going to go into what all the different ones are. I'm going to kind of more directly explain how you might consider, if you wanted to invest in commodities, how would you do it without going into a separate commodities market? Because a commodities market isn't something that, it's something you would have to have a broker to get into, but you can invest in commodities in a standard investment portfolio. There are 11 sectors in the stock market. And these sectors are divided into into different categories, if you will. So these are called these are based on the S&P 500, Standard & Poor's 500. Okay, and these 11 sectors are all labeled with X's. Let's see here. Oh, okay. I missed that. There we go. They're all labeled with X's, and so they are. There's an ETF for each sector. Okay. There's XLRE. That would be real estate. And that takes all of the real estate stocks in the S&P 500 and kind of lumps them all in the top ones into this ETF. Okay. There's let's see, XLF. That would be what we think F stands for.
Food,
Finances.
finance,
Financial.
Right.
XLU, utilities. XLP, is consumer products, which is kind of products. All right. XLC, communication. That would be like AT&T and Verizon, that type of stuff. XLB, building materials. So if you think, man, there's going to be a big boom in housing building, that's a good sector to be in, right? XLE is energy. I say I'm telling you these because of commodity idea. XLI is industrial. XLV is healthcare, which is, I don't know what the V stands for. Vaccination. Maybe. You may be right. XLY is discretionary. And then the last one is XLK. That is technology. Now notice these last couple, they don't make any sense. I mean, the rest of them you can see: industrial, energy, building, communication, products, utilities, finance, real estate. I don't know where they came up with the letters on these last couple. I think they were just running. All right, so if you wanted to invest in commodities, you could do it a couple different ways. You could go to a commodities broker and you could invest through a commodities broker, or you could go, you know what, I want to invest in energy stocks. Okay, energy, I think gas and whatnot is going to go up, or I want to invest in utilities. Utilities would be your electric companies, your water companies, these type of things. Okay, so you could go and find individual companies, right, that you might want to invest in, this individual power company or whatever, or you can go to an ETF like this that has the top utility companies in the country all put into one utility ETF, and you can buy this ETF, and then that gives you a part of all of these utilities and that are in that deal. Same with energy and so forth. Real estate, and that. So this is a way to invest in commodities without going through a commodities broker, but it's also, there's other options there. Now I'm talking about commodities, but I wanted you to kind of get that concept here, because there's also more direct commodity type things you can do, and that is, For instance, you can invest in GLOD. No, GOLD, gold, right? GOLD. And say you can buy gold, you can buy silver, or you can buy ETFs that own gold and own silver. SLV is a silver ETF. GLD is a gold ETF. GOLD is a gold ETF also. So you can buy it directly and hold it, or you can buy stocks and ETFs that do it, or you can buy companies that, like, you can buy stocks of mining companies, gold mining companies, and if gold's going up, gold mining companies are making more money, so their stock price goes up. So that's a way to invest in that. You can buy copper ETFs, or you can buy copper coins. So, I mean, there's different ways to invest in commodities, but if you're going to invest in oil, it's not likely that you're going to have, buy barrels of oil and keep in your backyard, right? So how are you going to invest in oil? Well, you're going to have to invest in Exxon or Mobil or whatever, or in the energy sector, which holds the top energy companies in one ETF. Okay, so if you're going to invest in commodities, this would be, the easiest way. Now, if you buy physical gold and silver, that's not bad. This is what Robert Kiyosaki says people ought to do: buy physical gold and silver. He's very much into that idea. I'm not against owning gold and silver. Okay, I do think that it's one of these. I think if it comes down to that, you're going to have gold and silver to buy and sell. You probably would be better to invest in brass. Ammo. All right. You understand what I'm saying? I mean, if it collapses to the point where people are only accepting gold and silver again, it's going to be such absolute chaos. You're going to be not wanting to stay around where anybody's at. Back in, remember Y2K? Everything's going to collapse. We had a guy in our church at the time who he was telling me, man, my neighbor, he is a prepper galore, man. He brought in the other day a pallet of water bottles. And he said, I saw him bringing it into his garage. And he said, I hope you're getting ready for Y2K, man. It's coming. He said, are you getting water and whatnot? He said, nah, I'm buying ammo. And he said, what are you buying ammo for? You can't drink ammo. This is literally his conversation with me in the foyer. You can't drink ammo. He said, if you have water and I have ammo, I'll have water. So, is it wrong to hold gold and silver? No, and it appreciates. It's not like it's a good appreciation value. Quite frankly, gold and silver is not a great appreciation value. It is a hedge against collapse. It goes up when the dollar goes down. It's getting ready to go up. So it's not a bad time to invest in gold right now, because they're getting ready to start printing infusing more money into the economy. So the dollar value is going to go down, and when the dollar value goes down, gold and silver will go up. But it's going to basically keep pace with inflation in its rise. In other words, its value is based on the dollar. So it's going to go up based on how much. So when you see gold going up dramatically, what you know is the value of the dollar is going down dramatically. And so it's kind of tied in that fashion. Even though it's not a gold-backed dollar, gold's value is, in that type of vein. It's not getting greater value because there's less and less of it. There's actually more and more of it. They're still mining gold after all these years. They're still pulling gold out of the ground, and sometimes they can pull it out because it's worth enough to pull out, and sometimes the mining companies just can't afford to pull the gold out of the ground because it's just not worth enough to spend the energy on. Okay, so it's not a terrible investment as far as just a hedge against inflation. It will basically hedge whatever inflation would be, but it's not likely that you're going to gain against inflation with gold unless there's just an absolute collapse, in which case we're all in worse trouble than you thought anyway. So that's my opinion on gold and silver. It's not bad to have. It's kind of cool. I like collecting coins, but it's not necessarily a super investment in that sense. Okay, that's again my opinion. You're going to find people that disagree with me, and they're probably right, and I'm probably wrong, but that's my opinion on that. Okay, any questions real quick before we take our last break? All right, let's take our last break, and then we'll start back up.